last quarter when the 5% GDP print came out, everybody thought that this was an aberration and it is just a one quarter low from which we will rebound. Even the Reserve Bank of India governor said that he was quite surprised to see that 5% print. And now we hear that from most agencies after the current IIP number that this quarter's GDP growth number could be as low as 4.25% or 4.2%. That will be a real shocker. Now we keep talking about it being a low every quarter, but quarters seem to pass and the direction remains downward. So things are not getting better as quickly as we would like them to be, and the manufacturing problem is particularly bad. All indications are that this festive season, which might lead to a little bit of a recovery, has not been that pronounced in terms of ushering in a massive reversal in fortunes, economically speaking. So I think the macro remains quite bad, and the government's tax collections and therefore dwindling direct tax collections have actually gone up at a very, very small pace. The GST numbers keep disappointing month after month after month, and the government, given that it has had to do a lot of the heavy lifting in terms of giving the economy a bit of a push, is severely fiscally constrained at this point in time after its stimulus measures. So yeah, we are in a strange situation. The growth is not picking up, the fiscal situation is getting worse, and the clamor for more action from the government is getting louder and louder. So, and the market is at all-time highs or nearly all-time highs. I don't know whether all of this can sit together. Right now, of course, the mood is good, liquidity is strong in the market, and therefore it's chugging along nicely. But I think sooner or later the macro headwind might come in the way of the market, because it is taking longer for the economy to bottom out and much longer than what investors thought it may have taken. Well, interest rates in the US have come down. That was the starting point, I imagine, of the dollar carry trade into emerging markets once again. And this rally that we witnessed in India is very squarely a global rally. All markets have done well. If you look at other Asian markets, emerging markets, India had underperformed in the period leading up to September, October, and therefore we have played a little bit of catch up. That much you can say. However, this has been a global rally. Metals have done well, metal stocks have done well, and the two reasons are, one, of course, is that the world is thinking or hoping that there will be a resolution soon of the US-China trade standoff, and B, interest rates have come down, bond buying programs have begun in the US again, and therefore the dollar carry trade is flourishing once again. In the last 3 or 4 weeks, domestic investors have been sellers, but FIs have pumped in nearly $2 billion. I think that is really the source of the rally this time around. Large caps have led, fueled by FII dollars, and that is why the macro is not seeming like such a big problem, because the macro is a problem everywhere in the world. However, if for some reason the global money were to stop or the tap were to go off, I think people will start fretting about the economic problems once again, and the market might struggle. So, fueled by this global liquidity, we might go on to make a new high on the Nifty and even go a bit beyond that. But a runaway rally is very difficult to envisage given the economic underpinnings. This has been a source of some optimism for the market. The fact that reported profit after tax numbers are a bit better than the previous quarters. However, a closer look at that indicates that this is largely on account of lower tax assumptions because of the corporate tax cut. If you take that out, numbers or the reported PAT numbers have not been that great. And the key thing that I look at in determining whether there has been some kind of recovery in the basic business of companies is the top line number. If you look at the 28 of the 50 Nifty companies which have reported till early November, the one number which stands out for me is that the sales growth is still negative. There is no growth at all. In fact, it is negative. Now, when revenue growth is negative year on year, you cannot say that there has been a remarkable recovery. The PAT numbers have gone up about 10-11%, but that's because of lower tax assumptions. Other than that, the numbers have not been great. And most of the growth which is coming in is thanks to the corporate tax, thanks to the corporate banks. We know that ICICI Bank and State Bank of India are showing substantial recoveries in their numbers, and I still think that most of the FY20 numbers growth, whatever the Nifty demonstrates, will be from these corporate banks and from no other sector. Things are very sluggish. At 4-5% GDP growth, it stands to reason that Indian companies will not be able to demonstrate very strong growth numbers other than the arithmetic of the one which is based on lower tax assumptions. Look, I have consistently said on your platform, even the last time we spoke on Moneycontrol, that the 3 C's still look strong, which is corporate banks, consumption, and chemicals. And I maintain that if you look at this quarter's numbers as well, the consumer companies have done well. We've seen very good numbers from the likes of Britannia, ITC, Asian Paints, HUL. So I think, there are marginal wrinkles on margin from Nestle and all, but overall, I would say consumption numbers have held out in a difficult economic environment. Corporate banks have been even better. ICICI Bank and SBI particularly have been very strong. Axis and IndusInd Bank have not been that good, and the stocks have not therefore performed. But broadly speaking, the larger corporate banks have done well. And chemicals, you look at the smaller chemical companies who have reported so far and who will continue to report, their stocks have done well, the earnings have been quite good. So these 3 sectors I remain quite optimistic about. But beyond that, to think of new sectors at this point in time looks difficult. I know there has been a real estate package, and a couple of them like Godrej Properties, etc., look like, not because of the package, but look like they could start to improve, and their stocks have also done well. But I don't see any great sectoral plays as such in the market from here on, other than the 3 that I mentioned. I tried to look at the listed space and see which companies they help, but I cannot say that for investors this is a big bonanza, as in companies, listed companies X, Y, Z will actually show much better earnings or clear off a lot of the backlog, inventory backlog, because of the package. In any case, the size of the problem is so large, Santosh, now that it's many lakh crores, that this 25,000 crore odd package, everything helps on the margin, because it's a difficult sector, it's a jammed sector, and therefore the government's intentions and the government's efforts are welcome. But I don't think it will solve the real estate sector's problems beyond a point. And if people are looking to invest in this sector, they still have to go back to the 2 or 3 companies which are demonstrating growth in a difficult environment, which is again the same list of companies, your Godrej and Shobha and Prestige. But beyond that, to look at real estate investment seems like a bit of a challenge. The first thing which strikes me is that I think a lot of people may be thinking, we all have memories of Satyam computers, whether something as bad as that can unfold, and I would say categorically that the chances of that are bordering on nil. So you get that out of the way. Now, could there have been some wrongdoing? We can all conjecture, we can all speculate, but the fact is that we don't know the real facts, and let the investigating team find out whether there is any merit to the whistleblower complaints or they are frivolous in nature. Prima facie, some of them seem quite frivolous in nature. Are all of them frivolous? We don't know. So we'll wait for the verdict. What can happen to the stock in the interim? I think the chances of Infosys actually rallying significantly till the charges are cleared are low. It might form a bit of a range between, say, 650, 660 on the lower side, and maybe 725, 730 on the higher end. That may be the trading range for Infosys till we get a clean chit or some kind of announcement from the team which is looking into the probe. If the stock goes to 650 kind of levels or near that, I think valuations become compelling once again. I don't set too much store by all these comments about God cannot change Infosys numbers and all of that. That's in the realm of the dramatic. I don't think it is pertinent to what investors should think about the company. But a mild bit of derating has happened already, and I think much of it has been priced in. And once the probe is closed, we can probably see Infosys catch up with TCS valuations a little bit once again. assuming that a clean sheet comes out. But my own guess is that any significant evidence of wrongdoing may not be found. That is quite unlikely, though one cannot say for sure. This is a thing which a lot of investors are trying to grapple with right now, because there is a debate in the market on whether one should be coming out of the stocks which have been demonstrating growth but are trading at very high valuations, and to expand the universe of investments to slightly lower valued stocks which might be demonstrating growth. I think it's a difficult call to take, particularly because of the macro underpinning. You can see that this effort is on, this hunt is on in the market, because even in the leader sectors like banking, stocks like RBL, Yes Bank have staged a comeback, and HDFC Bank and Kotak Mahindra Bank have not done very well. They've actually underperformed the banking index a bit over the last 3 weeks or so. So the rotation, or a hint of a rotation away from quality to lower valued, to slightly lower down the value ladder, I think is already underway. But the point where one gets stuck is when one looks at the underpinning macro. If GDP growth is 4 and 5%, this is typically not the kind of environment where mid caps and small caps do well. So if you wish to buy mid caps and small caps, you will have to become very stock specific. You can say that I want to buy some mid caps or not very large caps in the insurance or asset management company space because it's a segment which is showing growth. Fair enough. That's a niche segment, few stocks, and you can find 1 or 2 good investable companies out there. You can say the same about electrical cables or pipes maybe, but there are a couple of companies which even in this quarter have demonstrated some growth. But it cannot be a macro call yet about mid caps and small caps, which is a debate which I hear a lot, that now mid caps will do much better than large caps. Now the time for mid caps has come. All of this is fine in principle, but I think you still have to be very stock specific, because the basic driver, which is the underlying economy and the economic conditions, are still quite tricky, and that is not an opportune time for buying or taking a macro call on mid caps and small caps as an asset category. I still think there is enough scope for large caps to do better, and select mid caps and small caps which have demonstrated good earnings in the current quarter in difficult economic conditions. They might attract your attention, but a blanket mid cap versus large cap call is still very difficult to take.